Guys, if you're watching this right now, you know why we're here. It happened. Silver didn't just touch $70. It literally blasted through that barrier and set a new all-time record, $71.11 per ounce on American markets. That's right, $71.11. The barrier everyone thought was unbreakable. The level where banks were supposed to pull out all their killer moves. And what? Total failure. Guys, for the silver market, this is one of those historic days we're going to be talking about for many years. December 23, 2025, the day silver once and for all proved that physical demand is king, paper games are crashing, and the squeeze we've been waiting for has already arrived. If you've got physical silver or futures in your portfolio, congrats, this is your moment. If you're still on the sidelines, pay attention, because what happened today changes everything. Let's break it all down, the exact price action, how we got to $711, why the pullback happened, geopolitical triggers, inventory drains, and most importantly, why banks' desperate attempts to hold back the rally just blew up in their faces. On December 23, 2025, the spot price of silver exploded to an intraday high of $71.11 per ounce. This is the first time in history silver touched the $71 mark. Not just a touch, but a solid breakthrough. Charts show it, bid at $70.64, ask higher, with the high stamped at $71.11. Trading economics confirmed the close around $70.96 on some feeds, up 2% for the day. Reuters straight up wrote, silver crosses $70 milestone for first time, extends record run. FX Street noted the rise, pointing out the metal reaching new peaks amid safe haven demand. This isn't some overnight flash. Silver's been climbing all year. Year to date, up 137 to 140%. The strongest annual performance since 1979 to 1982, when silver went parabolic. From below $30 at the start of 2025 to $71 now, that's a doubling in 12 months. And just in December alone, plus 35% for the month. The charts are on fire, higher highs, higher lows, parabolic acceleration. But let's zoom into today. Silver opened strong, around $68.96 to $69. Climbed steadily through the European session on the back of geopolitical news. Then in the American session it just rocketed up. By midday we were flirting with $70. And boom, $71.11. Traders on X were losing their minds. Posts like, silver $71, banks in full panic mode, were going viral. Volume picked up despite the holidays. Comex March futures closed strong at $71.40, up 3.61%. Then the pullback, price came back to $69 to $70 by the end of the session. Why? Classic profit-taking. After a spike like that, traders lock in gains, especially in thin holiday trading where liquidity is low and moves get exaggerated. The dollar came back a bit stronger, DXY up 0.3%. Selling pressure kicked in. But this isn't a reversal. It's consolidation. The market just catching its breath after climbing $18 in under a month from November lows. That's normal in a bull market this hot. The close held above $70 in futures equivalents. The breakout is intact. For perspective, the old all-time high from 1980 was $50 nominal, which is over $150 adjusted for inflation today. 2011? $48.70. Silver was suppressed for decades, trading in the $20-30s while gold flew. But 2025 changed everything. We broke $50, then $60, then $65, and now $71. And the acceleration is textbook parabolic. The intervals between $10 moves are shrinking, $60 to $70 took days, not months. Banks tried everything, and nothing worked. Margin hikes in December, from 9.5% to 15%. Spoofing, rumors, fake sell walls to scare people off. Nothing. $71.11 happened anyway. The kill switch, this idea of emergency rules, liquidation only, forced majeure, completely failed. Physical demand just steamrolled the paper market. Why? Because this rally isn't just speculation. These are fundamentals on steroids. Triggers and fundamental drivers. Geopolitics lit the fuse today. And I mean really lit it. We're talking about sanctions on Venezuelan tankers. Not threats, but real enforcement actions, blocking oil flows. This isn't theoretical anymore. Ships are being detained, insurance pulled, payment systems frozen. Venezuela's already fragile oil infrastructure is now under direct economic pressure from economic warfare. Then comes the cyber attack. A confirmed attack on PDVSA, Venezuela's state oil company. Systems down, operations disrupted, production potentially impacted for weeks or months. Why does this matter for silver? Because energy disruption equals inflation risk. Oil markets get nervous. Supply chains start pricing in delays. Production costs rise. And when energy security becomes a question mark, investors flee to hard assets. Silver historically has been one of the best inflation hedges alongside gold, with the added bonus of industrial necessity. So when Venezuelan oil comes under threat and energy markets start getting jittery, silver catches a bid. Safe haven buying poured in today, investors hedging uncertainty. And this isn't just retail. We're talking institutional flows, sovereign wealth positioning, maybe even central banks quietly adding to reserves. But that's just the immediate trigger. The real context is broader. Geopolitical risk is escalating simultaneously on multiple fronts. US-China tensions haven't eased. The Middle East remains a powder keg. Russia, Ukraine still unresolved. Taiwan Strait simmering. BRICS expanding, challenging dollar hegemony. De-dollarization accelerating. Countries settling trade in yuan, rupees, even gold. Each of these threads pulls investors toward tangible assets. And silver at $71 is still massively undervalued compared to gold when you look at historical ratios and industrial demand fundamentals. Then there are Fed signals. Today we got fresh commentary from Governor Christopher Waller, historically hawkish, talking about more room for easing in 2026. Markets immediately priced in 2 rate cuts for next year. The December FOMC dot plot already hinted at this, but Waller's comments confirmed the shift in tone. Lower rates mean lower opportunity cost for holding non-yielding assets like silver and gold. The dollar softened early in the session, not a crash, but enough to give metals a lift. And when you combine falling rates with rising inflation fears from geopolitical energy risks, you get the perfect storm for precious metals. Reuters nailed it, perfect storm of rate bets and geopolitics. That's exactly what happened. But even that undersells the real structural engine driving this rally, supply-demand fundamentals that have been building for years and are now reaching a critical inflection point. The structural silver deficit. Let's talk about deficits, because this is where the story gets truly explosive. We're in the 5th straight year of structural silver deficits. This means that for 5 consecutive years, global silver consumption has exceeded global silver supply. The numbers, depending on the source, Silver Institute, Metals Focus, CPM Group, show deficits ranging from 95 million ounces on the conservative end to 149 million ounces on the aggressive end. Specifically for 2025, estimates converge on 118 to 149 million ounces. Some people hear deficit and think it's no big deal. They figure we'll always find more silver or recycling will fill the gap. But here's the reality. Mine output is essentially flat. Global mine supply has been stuck in the 800 to 850 million ounce per year range for several years now. Why? Because silver is predominantly a byproduct. About 70% comes from lead, zinc, copper, and gold mines. You can't just turn up silver production without economic incentive to mine more of the primary metal. And with those metals facing their own supply constraints, capex challenges, permitting delays, and ESG pressures, new silver supply isn't coming online fast. New silver mines? That's 10 to 15 years from discovery to production. No cavalry coming in 2026 or 2027. The projects that will matter are being planned right now for the early 2030s. Meanwhile, existing mines are depleting. Mexico, the world's largest silver producer at around 200 to 230 million ounces per year, faces regulatory uncertainty, labor issues, and resource nationalism. Peru, second place, has similar challenges. There's no massive new discovery waiting to flood the market. Recycling helps, but it's limited. Industrial recycling, recovering silver from electronics, photovoltaic panels, medical equipment, adds maybe 150 to 200 million ounces annually. But lots of silver in industrial applications is effectively consumed, dispersed in such tiny quantities per unit that recovery is uneconomic. Solar panels, for example, contain tiny amounts per panel. And recycling infrastructure for end-of-life panels is still developing. Plus, with silver prices rising, hoarding behavior increases. People are less likely to sell old silver products when they expect higher prices ahead. So you've got supply stuck at around 1 to 1.1 billion ounces total, mining plus recycling, and demand running at 1.1 to 1.3 billion ounces. That gap has to be filled somehow. How? Above-ground inventories, silver sitting in vaults, ETFs, strategic reserves. And those inventories are shrinking. Industrial demand, the new driver. But industrial demand is what makes 2025 fundamentally different from 2011 or 1980. Back then, silver rallies were driven by investment and speculation. This time, industrial demand is leading the charge, and it's inelastic, meaning manufacturers need silver regardless of price, up to a point. Solar photovoltaic panels are the #1 industrial use. Estimates for 2025 put solar demand at 260 to 300 million ounces. That's up from 197 to 232 million in 2024. Why the jump? Global solar installations are booming. China, US, Europe, India, all expanding capacity. Silver is essential for the conductive paste in solar cells. Yes, there's been thrifting, reducing silver content per cell by 10 to 20% through better metallization techniques, but total installations are growing faster than thrifting can offset. Plus, newer high-efficiency cell technologies like Topcon and HJT heterojunction actually use more silver per cell, 30 to 50% more. So as the industry upgrades to better panels, silver intensity increases. Electric vehicles are another massive demand driver. Each EV uses 25 to 50 grams of silver. Doesn't sound like much, but when you're producing 5 million vehicles like BYD this year, or Tesla's 2 million plus target, it adds up fast. Estimates for EV-related silver demand in 2025 are around 50 to 100 million ounces, including the vehicles themselves and charging infrastructure. Every charging station uses 15 to 30 grams of silver in contacts and wiring. We need tens of millions of chargers globally to support EV adoption targets through 2030. That's cumulative demand baked in. Then there's the AI and data center boom. This is the wild card that few were pricing in 2 years ago. AI servers, massive GPU clusters running ChatGPT, Claude, Gemini, and training next-gen models. They require high-density power delivery and thermal management. Silver's role: conductors, connectors, thermal interface materials. A single AI server rack can use 2 to 3 times the silver of a traditional server. Hyperscalers, Microsoft, Google, Amazon, Meta, are building out AI capacity at breakneck speed. Current estimates put AI data center silver demand at 5 to 15 million ounces in 2025, but projections for 2030 are 50 million ounces or more. That's a 10x increase in 5 years. Add in traditional uses, electronics, phones, laptops, appliances, medical antibacterial coatings, imaging, industrial catalysts, mirrors, bearings, all stable to growing. Total industrial demand is 55 to 60% of total consumption. And it's not optional. Samsung can't make solid-state batteries without silver. Tesla can't make EVs without silver. Solar manufacturers can't hit efficiency targets without silver. This is why the rally to $711 isn't a bubble. It's a repricing. The market is waking up to the fact that industrial demand alone exceeds reliable new supply, and investment demand is piling on top. Silver ETFs globally hold around 1.1 to 1.2 billion ounces. The big ones, iShares Silver Trust, SLV, with roughly 500 million ounces. Sprott Physical Silver Trust, PSLV, with 200 million plus, and various others. In the first half of 2025, we saw net inflows of 95 million ounces into ETFs. That's investors buying paper exposure to silver, which requires the funds to buy and vault physical metal. When SLV adds 10 million ounces, that's 10 million ounces off the market. Year-to-date for 2025, SLV has seen inflows exceeding $2 billion. Monthly inflows hit $1.5 billion. This isn't retail chasing hype. This is institutional money. Pension funds, hedge funds positioning for higher prices and hedging inflation. PSLV, which is popular with the sound money crowd because it's fully allocated and redeemable, saw $10 billion in net asset value by mid-October and has been climbing since. These inflows matter because this is patient money. ETFs don't day trade, they hold. That metal is locked up. Physical coin and bar demand, mixed picture, but trending up. The U.S. Mint reported a 30% decline in Silver Eagle sales for 2024 versus 2023, but that's because premiums were high and many stackers were already positioned. However, Q4 2025 has seen a resurgence. Premiums on retail products are holding at $2 to $10 over spot, sometimes higher for popular items like Eagles or Maples. Dealers report tight supply on certain products, longer wait times, strong demand from both new buyers, FOMO as price rises, and experienced stackers buying dips. Globally, coin and bar demand is expected to be up 7% for 2025 after a 22% drop in 2024. That 2024 drop was profit-taking after the 2021 and 2023 runs. But now, with price breaking records, attention returning, and geopolitical fears rising, retail is back. Comex inventory and what's happening in the vaults. Comex silver inventories are split into two categories, registered and eligible. Registered is metal available for delivery against futures contracts. It's sitting there allocated, ready to go. Eligible is metal in the vaults but not registered for delivery. It's privately owned, maybe by a hedge fund or dealer, and they can register it if they want, but they're not obligated to. For years, the system relied on a large cushion of eligible silver that could be converted to registered if needed. The logic: if deliveries surge and registered stocks drop, eligible owners would register their metal to take advantage of any tightness or backwardation, spot premium over futures. But that's not happening. In fact, the opposite is happening. Recent vault reports, last 2 weeks leading into today, December 23, show over 3 million ounces withdrawn from eligible inventories. That's owners saying, I want my silver out of the Comex system entirely. Not converting to registered, not trading it, removing it. Registered is essentially frozen. No significant inflows. The metal that's there stays registered because owners might be hedging with futures, but no new metal is entering to replenish withdrawals from deliveries. Mid-year 2025, total Comex silver stocks, registered plus eligible, were around 460 million ounces. By late December, we're at approximately 450 million ounces. That's a 10 million ounce net decline over 6 months. Not huge in percentage terms, but the trend is what matters. And within that, eligible took the brunt, dropping 15 to 20 million ounces, while registered has been relatively stable or even up slightly as some eligible converted. But here's the kicker, in the last 2 weeks, over 3 million ounces left eligible with almost zero coming in. That's a pace of withdrawal that if sustained would drain 50 million ounces in a year. And this is happening while price is at all-time highs. Normally, high prices bring metal out of hiding. People sell at highs. But not this time. This time high prices are triggering the opposite. Holders are pulling metal out because they expect even higher prices, or they don't trust the system to deliver if a real squeeze happens. Why would someone withdraw from eligible? Several reasons, all pointing to the same belief: this isn't over, and I want my metal in my hands, not in a vault where it might get caught up in a default or rule change. First reason, strong hands accumulating. These are big players, family offices, sovereign wealth funds, maybe industrials securing supply ahead of need. They see the deficit math. They see industrial demand growing. They see geopolitical risk. And they're taking delivery, not paper. Not ETFs, though some use those. Physical bars in their own allocated vaults or storage under their control. Second reason, distrust of the Comex system. There's a long history of rule changes during crises. 1980, Hunt Brothers squeezed silver to $50. Comex changed rules to liquidation only. Price crashed. 2011, margin hikes killed the rally at $48. The fear, justified or not, is that if silver truly squeezes and threatens the shorts, the banks, the commercials, the exchange will change the rules to protect the system at the expense of longs. Third reason, premiums. Physical silver is trading at premiums over paper. Retail coins and bars $2 to $10 over spot. Some specialty products even higher. If you're a dealer or refiner with metal in Comex eligible, you can pull it, refine it into retail products, and sell at a premium. Why leave it eligible earning nothing when you can monetize the physical premium? Fourth reason, rehypothecation and lease fears. Eligible metal isn't necessarily sitting idle. It can be leased, used as collateral, moved around. Owners might not want their metal tied up in opacity when visibility is key during volatility. Result, eligible draining and registered not refilling fast enough. If this continues, if eligible keeps falling and registered stays flat or falls too, the deliverable pool shrinks. Comex open interest in silver futures is massive, hundreds of thousands of contracts, each representing 5,000 ounces. Most settle in cash, never taking delivery. But what if even 5% stand for delivery? Or 10%? That's millions of ounces of demand against registered stock that's maybe 100 to 150 million ounces. In a normal market, no problem. Eligible converts or new metal flows in. But if owners won't convert and no new metal comes, you get a short squeeze. Not a speculative squeeze where shorts cover and price spikes temporarily. A structural squeeze where there's not enough physical metal to deliver, forcing cash settlement, rule changes, or worse, default. The banks know this. The commercials know this. That's why they tried the kill switch today. Margin hikes, spoofing, whatever tools they have. But it didn't work. Price still hit $711. Why didn't it work? Because the demand isn't leveraged speculators this time. It's physical buyers, it's industrials, it's sovereign entities. And you can't margin call a factory that needs silver for production. Shanghai and the global picture. The Shanghai Gold Exchange is the hub for physical silver trading in Asia. Chinese demand for silver has been massive, both industrial, China makes most of the world's solar panels and EVs, and investment, Chinese citizens buying silver as an inflation hedge and wealth preservation. SGE silver inventories are also declining, multi-year lows in some reports. Why? Because China is consuming more than it imports, and domestic production isn't filling the gap. The Chinese government is also quietly accumulating precious metals. Official reserves show gold increases, and rumors persist of silver accumulation too, though data is opaque. When Shanghai stocks are low and Comex stocks are falling, the global available-for-sale pool shrinks. Arbitrage opportunities arise. If Shanghai silver costs more than London or New York, you'd ship metal east. But shipping takes time, and if the premium isn't large enough, it doesn't happen. Plus, with supply tight, traders are less willing to move metal around because they might not be able to replace it easily. Result, a fragmented market. Price in New York, Comex, price in London, LBMA, price in Shanghai, SGE, and price for physical retail, coins, bars. They should be tightly linked, but during stress, they diverge. And we're seeing early signs of divergence: physical premiums rising, delivery delays, vault withdrawals. These are the footprints of a market under stress. J.P. Morgan and the historical manipulation narrative. For years, decades really, the silver community pointed to J.P. Morgan as the big short suppressing silver prices. And there's evidence. J.P. Morgan paid $920 million in fines in 2020 for spoofing precious metals markets. Traders admitted to placing fake orders to manipulate prices. This isn't conspiracy theory. It's legal record. But here's where it gets interesting. Reports over the last few years suggest J.P. Morgan has flipped. Instead of being massively short, they've been accumulating physical silver. Estimates range from 500 million to 750 million ounces stored in their own vaults, not Comex eligible. That's more than 500 million ounces. If true, J.P. Morgan is now one of the largest private holders of silver in the world. Why would they flip? Because they did the math. They realized the deficit is structural. Industrial demand is inelastic. And trying to suppress the price with shorts is a losing game long-term. Better to cover those shorts, buy physical cheap, which they did in the $20s and $30s over the last decade, and ride the bull on the long side. Recent J.P. Morgan research reports have been bullish on silver, forecasting $70 plus prices, citing supply deficits and industrial demand. That's a stark change from the bearish tone of the past. Does this mean manipulation is over? Not entirely. Spoofing still happens, fake sell walls, algorithmic games. But the scale is different. If J.P. Morgan is long physical, they're not incentivized to crash the price anymore. They might manage volatility to accumulate more, but their interests have shifted. Other banks, some are still short, stuck in old positions or hedging industrial exposure for clients. But the grip is loosening. The kill switch today failed because the big players aren't united in suppressing price anymore. What comes next? $71 is just a milestone. It's not the destination. Analyst forecasts for 2026 are converging on much higher prices. Peter Schiff is calling for $100 silver in 2026. His thesis: the Fed will restart quantitative easing, stealth QE through balance sheet expansion or emergency programs. Inflation will stay elevated or reaccelerate, and metals will be the escape valve. Schiff's been early before, but his track record on calling inflection points in precious metals is strong. Clem Chambers is even bolder, $100 plus on the AI energy supercycle. His argument: AI's energy demands are so massive that they'll strain grids, force infrastructure build-outs, and create commodity supercycles. Silver, as a key material in energy tech, benefits disproportionately. Wisdom Tree, a major ETF provider with robust research, is forecasting around $75 for end of 2026. Their model incorporates rate cut expectations, dollar weakness, and supply constraints. More conservative than Schiff or Chambers, but still 25% upside from current levels. BNP Paribas and other investment banks have quietly raised targets to $100 by mid-2026, citing the supply crunch and industrial demand acceleration. These aren't fringe voices. These are mainstream analysts at major institutions. Kitco's survey of traders and analysts for 2026 shows average predictions of $80 to $90. The range is wide, some as low as $60 if recession hits and industrial demand crashes, others as high as $150 if full squeeze plays out. Ultra bulls compare this setup to 1980, when silver hit $50 nominal, over $150 inflation adjusted today. They see potential for $150 to $200 if a real mania takes hold. Which scenario is most likely? Honestly, nobody knows for certain. Markets are probabilistic, not deterministic. But fundamentals support higher prices. The deficit isn't going away. Industrial demand is locked in. You can't unbuild the EV factories or solar plants. Investment demand is just starting to ramp as mainstream money realizes the story. Physical supply is tight and getting tighter. My base case: $75 is the next major resistance. We'll test it in Q1 2026. If it breaks cleanly on volume, we run to $85 to $90 fast. From there, $100 is in play by mid-year. Pullbacks along the way? Absolutely. But the trend is up. Bull case: we blow through $75 and never look back. $90 by Q1, $120 by mid-year, $150 if a squeeze triggers. This happens if industrial demand surprises to the upside, more EV adoption, faster AI build-out, and/or Comex has delivery issues sparking panic buying. Bear case: economic slowdown, recession, or severe slowdown cuts industrial demand by 10 to 15%. Investment demand wanes, price pulls back to $60 to $65, consolidates for months. But even in the bear case, the deficit persists, smaller, but still there. And any recovery sends price higher again. Real risks worth acknowledging. Dollar strength: if the Fed pauses rate cuts or signals tightening due to re-accelerating inflation or a strong labor market, the dollar could rally. Stronger dollar typically pressures commodities priced in dollars, including silver. We saw this play out in the late session today, DXY up 0.3% and silver pulled back from highs. If DXY runs from 106 to 110, silver could consolidate or dip to $65 to $68. Economic slowdown: recession fears could hit industrial demand. EV sales might slow if consumers pull back. Solar installations could delay if financing tightens or subsidies cut. Data center build-outs might pause if AI hype cools. A 10% drop in industrial demand would cut 100 million ounces from consumption, narrowing the deficit. Not eliminating it, but reducing urgency. Technological substitution: what if someone invents a silver-free solar cell or battery tech that doesn't need silver? Unlikely in the next 2 years, but longer term it's a risk. R&D is ongoing. But even if breakthroughs happen, deployment takes 5 to 10 years. The demand is now, supply response comes later. Supply response: what if high prices incentivize massive new production? In theory, yes. In practice, slow. Mines take years. Recycling can grow, but has limits. Primary silver mines where silver is the main product, not byproduct, are rare and small. Realistically, supply response for 2026 is minimal. Regulatory or exchange intervention: the kill switch we talked about. If Comex or other exchanges impose draconian measures, force majeure, liquidation only, cash settlement mandates, this could temporarily kill the rally. Legal? Maybe. Fair? No. But it's happened before. Risk always exists. However, with industrial players now involved, not just speculators, intervention is harder politically and economically. Where does that leave us? If you're holding physical silver, congratulations. You're positioned for what could be a historic run. The frustration of the last few years, the sideways grind, the fake breakouts, the manipulation narratives, it all led to this moment. $711 is validation, but it's not the finish line. It's mile marker 20 in a marathon. If you're new or on the sidelines, don't FOMO blindly. Volatility is coming. We could see sharp pullbacks. 10 to 15% corrections are normal in a bull market this strong. Those dips are opportunities. $71 might look expensive today, but if the path is to $100 or beyond, buying a dip to $65 or $68 is a gift. How to position? Physical first, always. Coins, bars, take delivery. Don't trust paper promises if you're in this for wealth preservation. If you're speculating for leverage, miners are the play. Junior miners can give you 5 to 1 or 10 to 1 leverage on silver moves, but they're volatile and risky. Pick companies with strong balance sheets, low costs, and growth projects. The allocation question: how much of net worth in silver? That depends on risk tolerance and conviction. Traditional portfolio theory says 1 to 5% in precious metals. But if you believe this is a once-in-a-generation setup, some go as high as 10 to 25%. Only you can decide. But having zero exposure at this point with everything we've discussed seems like a mistake. This is wealth transfer. That's what's really happening. Wealth is moving from paper holders to physical holders, from weak hands to strong hands, from those waiting for confirmation, which always comes late, to those who positioned early when everyone called them crazy. Today at $711, the confirmation is here. The mainstream will start paying attention. CNBC will run segments. Bloomberg will interview analysts. Reddit and Twitter will buzz. New money will flood in. Retail FOMO, institutional catch-up, maybe even an ETF frenzy. But the real move is ahead. When industrials can't get metal at any reasonable price. When Comex registered falls below 50 million ounces. When vaults are truly empty and dealers have nothing to sell. When paper contracts start cash settling because delivery is impossible. That's when $100 feels cheap. The silence now, that was the period where price was annoying, grinding sideways, dipping on no news, frustrating believers. That was the distribution phase. Weak hands selling to strong hands. Retail giving up to institutions accumulating. The market shaking out before the real run. Enjoy the silence while it lasts. Because when the storm hits, availability will be gone and price will be vertical. The banks know it. The commercials know it. The industrials know it. That's why there's desperation in some quarters, trying to manage the narrative, cap the price, delay the inevitable. But they can't stop physics. They can't print silver. They can delay, but they can't deny. And today, with $711, the kill switch failed. The paper system lost control. Physical won. Tomorrow, higher. Next week, volatility, but a higher trend. Next year, if fundamentals hold and the deficit persists and the crowd rushes in, we're talking about a repricing event that will be studied for decades. This is your moment. Hold the line. Demand delivery if you're trading futures. Be the strong hand when weak hands panic on dips. Accumulate on weakness. Celebrate strength. But don't get complacent. The battle isn't over. It's just entering a new phase. Thanks to everyone for being part of this movement. While the mainstream media sleeps, while banks scramble, while governments pretend everything's fine, you're here, learning, questioning, positioning ahead of the crowd. This isn't just a channel. It's a community of people who refuse to accept the official narrative, who do their research, who understand that paper isn't wealth, that premiums reveal shortages, that the biggest wealth transfers happen when nobody's paying attention. You're not late. You're early. The silver squeeze, the Comex breakdown, the repricing, it's all just beginning. $711 is the start, not the end. Remember, like and subscribe. If this message resonated, share it. Wake up your family, wake up your friends. The window to position is closing. The crowd is coming. Comment below. What's your target for silver in 2026? $100? $150? Higher? Stack smart. Stay strong. The future is silver.